Personal finance practice problem using OneNote. Retirement savings calculation using a future value of annuity calculation. Prepare to get financially fit by practicing personal finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side. We're in the Practice Problems tab down in the 1191 Retirement Savings FV of Annuity tab. Also note, when using OneNote, take a look at the Immersive Reader tool. Our presentations will also be in the text area with the same name, same number, but with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we got our information up top, calculations on down below. We're looking at about a retirement type of scenario. There's usually two kind of ways that you would think about or format your retirement plan phase. One would be from the standpoint of saving as much money as you can for what you can save, meaning when you're in your earnings years, you're going to say, I'm going to save as much as I can on a periodic by periodic basis, and then try to determine how much that will accumulate to in future value terms at some point in the future, and think about how much I will have at that point in time. The other is to first try to think about how much you're going to need at retirement, meaning you're going to think about the age that you're going to retire, think about your lifespan from that point forward and how much you'll need each point after retirement, which is an annuity type of calculation to think about how much you would need. And then during your earnings years, try to figure out how much you would need to put away in order to reach that particular goal. So here we're doing the first of the two. We're going to be looking at a situation where we're going to be putting money away at this point in time, saying what would happen if I put that $5,000 away each year for 40 years at a 7% rate of interest. Where would I be at the end of that time period? Now, also note, we might go into a little bit more complex calculation later, that you might have a more complex type of scenario. Note here that we're assuming an even amount that you're going to be putting into the retirement plan on a periodic basis, in this case, a yearly basis. And obviously, we have a rate of return that's going to be even. Now, the rate of return, you can't really guess all you can do is kind of guess an average rate of return over the 40 years because you don't know what's going to happen from that point. But you might think, hey, I'm not going to have an even $5,000 that's going to go into the retirement plan each year, because in my early years, if I'm starting early, which hopefully I can do, then I'm going to put less in during that time, and I'd put more in during my peak earning years and whatnot. And so you might have a difference in the amount that you put in. In that case, you could still use the present value calculations, but you couldn't simply do a nice even annuity calculation. So we might go into a problem like that in a little bit more detail. Right now, we're going to use this for the annuity type of calculation over a 40-year period. Okay, so we're going to imagine we're investing $5,000 a year for 40 years and see at an average rate of return of 7%, and think about where we would be then at that future point of time 40 years from now. Now, in this type of scenario, sometimes it's easiest just to simply run a running balance calculation. This type of calculation is perfect for that to be, and then we can see how much we would earn on a year-to-year basis. In practice, note that the two formats that you might want to take a look at generally would be Excel, first looking at possibly the future value calculation, and then do a running balance calculation like this to kind of verify it in your mind and give you more detail about the amount of increases, the amount of the revenue that you might generate, the kind of tax implications that might be involved in it, and so on. So let's see this. We're going to say, now this is a very long table that we have here, but if you have it in Excel, very easy to do. We do this in Excel, so you can take a look at that if you so choose. We're going to start off at period 1. Note that we're not starting off at period 0, because when you talk about an annuity, then you're talking about, usually if it's a normal annuity, that the payment happens at the end of the time period. So if you already have money in a retirement account, then again, we might do another problem that will simulate something like that in the future. But then you'd have to account for that amount that's already there and the earnings that you might gain on that, and then figure, the annuity type of calculation component to it as well. So here we're going to just do the annuity. So it's going to start at period 1. Be careful of that instead of period 0. We also can format an annuity that it starts, that this payment happens at the beginning of the year instead of the end of the year, but that's not a normal annuity, and we'll take a look at something like that in a future presentation as well. So be aware of the starting point, because that can throw you off in your calculations. Then we've got the investments. So that means investments for year one didn't earn any revenue in year one, didn't get a 7% return because it happened at the end of the year. We're assuming that means that the first time that it's going to earn money is going to be then in year two. And then we just do our calculation, our normal type of calculation, which would look something like this. 5,000 times 0.07 would be 350, and then we put another 5,000 in. So now we got 350 plus 5,000 that we're going to put in, plus the original 5,000. That should give us 10,350. We won't do this for the whole set here, but just note we'll do this a few more times. So now we got the 10,350. If I multiply that times 0.07, we're getting a 7% return. In year three, we got the 725. Plus we put in another 5,000 plus the original 10,350. So now we had 10,350 plus the 725 plus the 5,000 brings us to 16,075. Taking that amount times 0.07 means now we're going to earn in on that 1,125 plus we put in another 5,000. That means we had before 16,075 plus 1,125 plus 5,000 is going to bring us to 22,200. Taking that, we can multiply times 0.07. That's going to give us then 1,554 plus we put in another 5,000. So if we started at the 22,2 plus the 1,554 plus the 5,000, that then is going to get us to a 28,754. Now you can see, of course, that the amount of increase or the amount of revenue, whether it be interest or an average gain in our portfolio, is basically going up as we go up because, of course, we're putting another payment in each time. So it's going up significantly due to both the compounding on the interest that we're putting back in and the fact that we're putting more money in each period. So if we continue this on down, which would be a tedious process by hand, but very easy to do in Excel and highly worth doing, you can go all the way down and we get down to this 998,176. So 998,176 at the end of that 40-year time period. This is also useful because you can kind of see what the increase would be with regards to your earnings, and that might help you out with estimates of taxes. You can break this down to a monthly calculation. We'll do some monthly calculations in future presentations as well, so you can see how that might differ. But again, you can put this running balance into Excel even if you have a fairly substantial number of periods, simply copying it down and get that more information, making it a little bit more concrete in your mind. The other way you'd want to do this in Excel would typically be with the future value of an annuity calculation, getting right to that end result quickly. That would look something like this, equals negative. In order to flip the sign from a negative number to a positive number, you could put that negative in front of the payment amount, but I just put it in front of the F. Then brackets, we got the rate. The rate's going to be the 7%, comma, number of periods. The number of periods is going to be 40. Notice that these two amounts are referencing cell references instead of simply hard coding 0.07 and 40, which you could do, but in practice in Excel, you would typically want to pull those numbers from the table so that you can then run different scenarios from the table and adjust these numbers down here accordingly and do some what-if type of analysis. Then we have comma, and then because it's an annuity, we're going to be using the payment amount instead of the present value amount, and that would be then the 5,000, and that would then return us the result of that 998,175.56. Again, note that this number is nice, and this is what will typically happen if you go to a financial planner. They'll kind of jump to that number, and that's great, but it's useful oftentimes to really visualize this by putting it into a table and running down the table and kind of visualizing what's going to happen with regards to the money you're putting in, how much you're putting in versus how much is being earned throughout the process. That can jog your mind possibly for different ideas in terms of your retirement strategy. And then we got down here, now we can go on to the calculations that would be similar or more likely to be seen in a school setting. That would be something like the future value of an annuity formula, which would be future value of annuity equals P, which is not the present value here, but the payments of 5,000 times 1 plus R, which would be 7%, to N periods, which would be 40, minus 1 over R, which once again would be 7%. You can plug those numbers into the formula, work the algebra. We're going to make that formula into a table down below as we have in the past, similar to what you might see in a tax return or a financial statement type of format. I think it's useful to kind of visualize how you might break these things out into a table, work on your tables. So we got the outer column, P times this will be in the outer column. Then we're going to break out this numerator in particular in inner columns so that we can get the detail for it. So we got the payment, which is going to be the 5,000. That's the P. That's in the outer column. Then we're going to take the numerator, this whole thing, and that's going to be 1 plus the rate. So 1 plus the rate. Rate is 7%. 1 plus 7 is going to be 107%, or 1.07. Then we'll take that to the power of N, which is 40, to get us then to this number here. And let me plug that into the trusty calculator. Remember that you do need a calculator that you can take to the power of 40 here. So I'm going to use the scientific calculator here to do that. That's going to be 1 plus 0.07 gives us 1. Then we'll take that to the power of 40, which is this XY button. That takes us to the caret or power of, and then 40 periods. And that's going to give us that 14.974458 about. Taking this back to the normal calculator, back to the normal calc. And so then we've got minus 1. So that's going to be this part of the numerator, finally ending the numerator. That'll give us to the end of the numerator. That, of course, will give us 13.974458. And then we got the denominator, which was R. So R 7%. That then will give us this number. Let's do that in the calculator. 13.974458 divided by 0.07 gives us about, that's not right, 13.974458 divided by 0.07 is going to give us the 199,63511 about. And then we're going to take that and we're going to multiply it times P, which is in the outer column, 5,000. Gives us about 998,175.56. This number is more accurate than what we have up here because Excel will calculate the actual number even though we can only see so many decimals within it. Then we can finally do it with the tables. So this is a straightforward table type problem, just making sure that we got the proper table, remembering that there's 4 tables that you might then have, 2 present value tables, 2 future value tables, both of them having 1 annuity and 1 non-annuity table. This is the future value annuity table. We're simply going to take the 5,000 and multiply it times the amount in the table, noting that we're at 40 and 7 and 40. So 7% all the way down to 40 periods, which is way down here at the 199,635. 199,635. There it is, plugged into the table. So then we can multiply it out. 5,000 times 199.635 is going to give us that even here, 199,175. Now, obviously, we didn't have an even number up top, and that's because the real decimal is 199,635.11 and 112, and so on. The table down here is rounding it to 4 digits, which does result in that difference between the calculation on the annuity table or made with the use of the annuity table versus the other formats that we have used, including Excel formulas, the mathematical formula, and the Excel function. That difference usually immaterial for decision making, but one which could be used against you, right? Be used to verify the method that you used when you look at problems in a school setting.